Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Jonathan Twomley. How you doing, sir?
I'm well. I was ready to throw my computer through the plate glass window in my office today because it literally took 20 minutes for Zoom to connect today. So yeah, I'm sitting here twiddling my thumbs, waiting for something to happen. So, but other than that, I'm great. I feel great.
Other than technology issues, you're doing wonderful. Man.
Yeah. So technology and supply chain issues, right? I mean, I tried to order a new computer the other day. It said arriving August 31st.
Wow.
I should have ordered it because it's probably when I go back to order it now, it's going to say, September 10th or something. So it's dumb of me not just go ahead and pull the trigger. But
that's hilarious. Well, something I thought we should talk about is we obviously got a hot CPI reading. I don't know if you saw this morning. We also got today's hot PPI reading, right? 11.3. We obviously are both in the real estate game. I think the Fed, I don't think has any good options. They stayed too low too long. We have the yield inversion. There's a lot of stuff going on around cost of capital and rents, and just a lot of stuff going on in the U.S. economy, frankly, the world economy. Bank of Canada came out with a surprise 100 basis point move. Where should we start, Jonathan? There's just a lot going on that really could impact not only the economy, but real estate as well.
Well, absolutely. I mean, I think so. There's if you're talking about inflation and the Fed having to act and other central banks starting to act as well, there's really two big ways that this can affect real estate, and they can actually dovetail with each other and really have a much bigger impact, right?
Mm-hmm.
But one is obviously if interest rates go up, that increases your cost of capital. When your cost of capital goes up, it decreases the amount you're willing to pay. So people are going to pay less for real estate assets with interest rates going up, and that's already started to happen. We've already been seeing softness in pricing. We've already been seeing people able to retrade, and I think as we talked last week, the last 2 years were such a crazy time in multifamily real estate that even sellers realize, and when buyers are saying to them now, hey, interest rates have risen, I've got to retrade you, sellers are not resisting as much as they normally would, because they realize, like, you know what, he's right, Mr. Buyer is right. And also, hey, prices went up so much over the last 2 years that even if I take a haircut, I'm still making more money than I underwrote when I bought this deal. So I'm gonna, rather than take the chances of prices sliding further, I'm going to take that deal. So that's one thing, softness in pricing. The other thing is, if there is a recession, if we do wind up with a recession out of this that is more than, a mild recession, then that's going to impact rents, right? It's going to impact your ability to raise rents, because if, people start losing their jobs, it's going to have an impact on how much you can charge for rent. And some of the crazy rent increases that we've been seeing over the last couple of years with this whole work from home thing, I think you're going to start seeing some pushback from tenants saying, hey, I'm not paying the $700 additional rent that you want all of a sudden from me. And, and the next guy in line behind him is going to say the same thing. So if those two things happening at once could really impact pricing for multifamily, because a lot of people are paying high prices for multifamily on the assumption that they're going to get these enormous rent increases. So it's worth, quote unquote, overpaying now, because the idea is you're going to sort of catch up because of rising rents to a more comfortable internal cap rate, once you stabilize the property, et cetera. But if the rent increases go away, or even if you start seeing some markets where, landlords are increasing concessions because they're having trouble getting tenants, then that'll, further put pressure on prices, downward pressure, and you could wind up with starting to get some price declines. I saw somebody the other day post on Facebook that they've started to see multifamily deals listed with prices. Now, if you're coming from single family home world, that is not so. You'd say, well, what's the big deal? They have a list price, right? Everything have a list price? The answer is no, right? In commercial property, depending on what part of the cycle you're in, you're going to see list prices or not see list prices. Now, you see list prices when the market starts getting soft. Now, why is that? And before I explain that, I'll say, and when the market is hot, what you see is unpriced when it's listed. They'll say it's unpriced, or they'll say price to be determined by market, etc. Now, why is this? Well, in a very hot, it's all about psychological anchoring, right? When you have a price listed on your property, the buyer forms a psychological anchor, right, to that price. Now, depending on the part of the market cycle you're in, that anchor could be either an upper bound or a lower bound, right? And when the market is hot, what sellers are afraid of is inadvertently setting a low price by saying, hey, it's $5 million for this property, right? Because what they're thinking is the market, people just might get into a bidding war, and they don't want to inadvertently put any upper bound on that pricing by anchoring, by telling buyers they could get it for $5 million, right? Because then all the bids are going to come in around $5 million, right? If they leave it unpriced, you might get, a bunch of people bidding 6, and you get some crazy guy bidding 8, right? Because they don't know how to underwrite, right? So that's what happens. But when the market is softening, you see the opposite happening, where they're trying to anchor you into a higher price. So they start putting a listing price on it because they know that the market is falling, and they're hoping that if they say 5 million, you're going to think like, oh, okay, it's worth 5 million. Whereas if they left it totally unpriced, you might just underwrite it and be like, hey, I'm only offering 4 for this, right? They're hoping they're going to get you up to 4.5, 4.75, because they've anchored you at 5 million. So if you start seeing listing prices more frequently on deals, it means that the market is softening. Every once in a while in a hot market, you'll see a listing price on a deal that usually means it's a crappy deal, or that the seller is unrealistic. And they have not been able to sell it, right? So they're trying to anchor you into a higher price, like, because it's a bad deal. But you don't see very much of that. But if the market really softens, you're going to start seeing almost everything listed with a listing price on it. And that's a signal to underbid the listing price. I mean, if you know what you're doing, you see those listing prices, underbid them, right? If you don't see a listing price, that means it's a hot market, and like everybody's bidding high. So yeah,
it's pretty. That is, that psychology really does play in single family as well, except everything does have a list price, that anchoring aspect. It's funny. One of the things I've told my audience here in the last month or so is we are no longer paying list price, right? The market's coming to us. So again, treat that as the upper bound if you're looking for a great deal and kind of single family and whatnot. The other thing I wanted to talk about here is one of the guys I follow, Ken McElroy. I'm sure you know the name at least. He actually came out with a video, I think it was on Saturday, where he was basically highlighting what you and I have been talking about for 6 months, that there's a lot of risk in syndications, especially net new deals, right? Deals instigated over the last year. And again, it's bad assumptions, right? He's talking about, exit cap rates. He's talking about interest rate. He's talking about softer rents and collection and vacancy. And I found it really interesting because, again, for me, Ken's in the game, right? He's one of the big guys. He's probably got hundreds of millions of dollars, if not more, assets under management, probably billions. It wouldn't shock me. And you could tell he didn't want to kind of point at the new syndicators, but he's basically saying, guys, there's a lot of bad deals being done today. A lot of people are going to lose some money because everything went right for 2 years, and now the reversion of the mean is going to cause a lot of pain. And he always said scooping equity. Not a lot of people are going to scoop equity. And he said, best case, some of these folks might be locked up for a decade when they were planned to be locked up for a couple of years. So
what does he mean by scooping equity?
Well, basically saying you go buy a property 2 years ago, you fix it up, you go back and refi. The whole story is you do a cash out refi, you pay back your investors. Now you own it free and clear, infinite return, all that stuff. He's like, That's over, right? Lending is tighter, rates are higher, no longer getting 75% on a cash out, you're going to get 65. And he's like, if that's your game now, change your game, because it's not going to work, and you're going to hurt your LPs.
Yeah, I mean, and I think also, frankly, there's almost everybody who's in the syndication business right now at this point has never seen a bad market, right? I mean, syndication has been going on for years, just nobody knew about it. But in the last 10 years or so, because of social media and podcasting, et cetera, syndication has become much more widely known about and much more widely used and much more widely participated in by everyday investors. And I think most people who I noticed a huge number of new syndicators entering the market about 2016. Now those people are veterans, right? They've been doing this for 6 years. However, none of them have seen a down market, right? And a lot of them have had enormous success because a rising tide lifts all boats, right? So I think that people may have built up some bad habits, and I see people continuing to just make the same assumptions that they've been making all along, which have been, I mean, honestly, like just sort of truth telling on myself. I thought these were bad assumptions in 2016, 2017, 2018, but the market proved me wrong and proved those assumptions right. So a lot of people made a lot of money doing deals that I thought were pretty risky, right? However, now I think we're at that point where just continuing to do the same thing is going to wind up with people getting hurt. And especially if they came in even more recently, and all their experiences really over the last 2 years, we've had a really unusual market, and really, I mean, unusual in every way, unusual in cap rate compression, unusual in terms of rent growth, right? Unusual in terms of the amount of money that was coming into this business, because you had, all of the retail and hotel and other investors all flooding into multifamily because it was the only game in town that made any sense during COVID, right? All those things, that rising tide, well, we may look at it and say that was like a record, that was like a storm surge, right? And now that money is going flooding back out to other places, right? Part of it's, as you and I have talked about, just going to go into T-bills. The Treasury starts raising interest rates. There's a lot of investors out there who are like, that's what they want to invest in. They want to invest in super safe assets that even if they don't pay that much, they pay something. That's where they want to put their money, right?
Yeah.
There's a lot of money out there that wants to be in super safe investments like that, like T-bills. And T-bills have not been paying anything for years. So they've had to go and find other things to look at. Multifamily has been a pretty good one to invest in because it is pretty safe, right? But if you can go for true safety rather than pretty safe, right, then a lot of money is going to flood back in that direction.
I think there's a couple of things I want my audience to hear. We'll talk about where people can go and get a sample of the deals that you evaluate, because again, I bring you to the channel as conservative, and self-reflection is great, right? You saw risky assumptions. You took your chips off the table, which I still argue was the right decision at the time. The market went against you, right? Who could have seen this? And the people that got in, did okay. I think there's two things that are going to prove true, and I want to get them recorded so I can call them back. The operators who started in 2016, got a couple of deals done, were successful. Social media kind of ramped up at the same time. It has allowed them to build large operations that, frankly, now they have to feed. Now they were almost deal jockeys, and they have to keep the overhead fed. So they have increasingly done bad deals, and they're gonna lose people lots of money on lots of deals. Then there's the operators who got started kind of when I sold my apartments, right? I sold a couple of apartments in 19, which I argue would have been the right time ex-pandemic, for the same reasons, right? Cap rates got below the lower bound. And I'm like, time to go, right? This is a problem. Somebody else take it. If you've been in the last 2 years, you probably got lucky on your first deal, and now you're trying to ramp up. I see people posting deals today with bad interest rates assumptions, bad rent assumptions, bad occupancy assumptions, it's just everything is going to regress to the mean, and everything will be negative in multifamily. And these people don't have the reserves they're not only gonna hurt people, but they will be washed out. Their reputations will turn to mud.
Yeah, I think it's going to be tough. I mean, I was on a panel a couple, 2-3 weeks ago in Charlotte at the Multifamily Investor Nation conference, and so I've been doing with them this market snapshot, like current state of the market panel for 3-4 years now, and it's always been online. We had an in-person conference, which was really fun, but I sat with the usual panel that I sit with, and the consensus there was that a lot of the deals that happened in the last couple of years are gonna suffer some pain, because what's going to happen, especially if they went into those deals in the first place the way I would, with wanting to get long-term debt, fixed rate, as long as you possibly could, you don't have any refinance risk, right? And you're planning a long-term hold. Anybody who went in with that assumption is probably going to be okay. They'll ride it out, right? As long as their underwriting wasn't bad in the first place. The people who are going to get really hammered are the ones who, their whole deal was premised on, a rehab, raising rents, and then refinancing quickly, returning capital, or selling the deal or whatever very, very quickly, and especially if they had a variable rate debt, right? And so people like that who made those kinds of deals in the last 2 years may find themselves unable to execute that plan. They may get the rent increases if they've executed on their rehab quickly. They may be able to lock in those higher rents, but the second half of the equation, getting that refi at a rate of interest that makes sense for them, that's going to be the part that may be trickier to pull off, right? And so, really depending on how high interest rates rise, they may not have enough delta in there, because they go in at 75% leverage, right? They can only refi at 70% leverage, so that's already 5% that you've got to cover. And with rising interest rates, that just increases that amount that you're going to hit that DSCR, right? So debt service coverage ratio. So it may be hard for some of those people to bridge that gap if they didn't get that NOI, that net operating income, juiced enough with the rent increases that they were planning, right? So, but I see people, not only are some syndications at risk that happened in the last couple of years because they went in at such low cap rates. They're also planning. You and I've talked about this before, reversion to the mean, right? People went in at record low cap rates, and then they claimed to be conservative underwriters because all they did was just add 10 basis points a year for every year of projected hold, and came up with a reversion cap rate, right? And that's the conservative underwriting, right? But that's only conservative when the market's kind of at its midpoint, right? Not when you've got record low cap rates that are likely to revert to the mean, right? So if they haven't done some kind of they may. I know I have a tendency to kind of like drift all over the place. I'm sorry about this, but there is a point here. If they have, if they've done internal underwriting, which says, we know that this deal can survive at X higher cap rate or whatever, but we can't predict the future, so therefore we're just going to use that rule because we have no idea. That's okay, right? Because if they've done that internal work that says this deal, even if cap rates blow up, this deal is going to be okay, but we're telling our investors, well, here's what we think is happening because we can't predict the world. The better syndicators actually show that math, right? So like the deal I'm working on right now with Reed Goossens, Reed is really great about that kind of stuff. And he actually has a chart in the deal that says like, this is exactly what's going to happen if cap rates go up, interest rates go up. Actually, on this deal, we have fixed rate debt, so interest rates don't matter as much to us. But like if cap rates rise, this is what's going to happen, right? So, and it actually shows like they can rise pretty substantially. And, obviously it impacts the returns, but it shows that like the deal will still survive, right? So if you've done that work and you say, look, no crystal ball, so I'm just going to I'm going to project at the rule, that's fine. But I think a lot of people don't actually do that work. I think a lot of people just like, they're like 10 basis points a year. That's the extent of it. That's all their analysis, right? And then they're making their projections based on that. a lot of those deals are gonna
Yeah.
blow up in people's faces. You know?
Well, do me a favor. I want people to realize that they need to take a look at what I think good conservative underwriting is. I think you have a deal you're working on now. If they are accredited, where could they go at least to get a sample of what a conservative, and folks take this, and if you're looking at other deals, compare them, and I think you will see, at least I have, that they're night and day different. So where would they go to get something like
Yeah,
that?
so if you are interested in joining my investor list, just Google Two Bridges Asset Management LLC, and you will find our investor page, and you can sign up there. You have to be accredited,
Mhm.
and because I only deal with accredited investors. You know, this particular deal I'm working on is in my old stomping grounds in South Carolina, using the management company that I used to use, that I introduced Reed to. I'm really excited about being back in that market because I really like it.
Mhm.
You know, we're going in at pretty low leverage, you know, 65% fixed rate. And you know, you can see how the deal is set up with the sensitivity analysis that's included in the deck that shows like, hey, occupancy goes down and cap rates go up, and there's just a whole grid. You can see how that's going to affect things.
Yeah.
So you know, that's what I think syndicators really should do, and the more sophisticated ones are doing that. You know, the folks that I work with include those kinds of sensitivity analyses in there. You know, when I sponsor my own deals, I'll be doing that as well.
Mhm.
You know, once I get back into that. So,
Yeah.
but right now I've got sort of enough people asking me to help them
Mhm.
that I tend to have sort of just gotten focused on that.
Yeah. So folks, I would get this if
Uh,
assuming you're accredited, I would get it so you can see what a good syndicators are doing, someone I trust and have experience with. Because again, a lot of the syndicators out here are really, in my opinion, are social media influencers and money raisers. They're not true operators and executioners. They've only known the greatest of great markets, and they're going to hurt you. Don't believe me. Look at it. Look at the comparison. Look at a conservative underwriting with multiple variable options, and then look at what they're putting out. Most of these other ones I've seen are not 65% leverage. They're not fixed rate debt. They're very short term. They have crazy assumptions. As an operator, I know what expenses and rent increases are, and some of these are, borderline criminal, in my opinion. They're so bad. But again, compare them. So one more time, Jonathan, where would they get it?
yeah, like I said, just Google Two Bridges Asset Management LLC, and you'll find on our website there's the investor, you know, tab which you can click on and fill out your information. You have to be accredited, but if you are, you know, I'll add you to the list, and you can start seeing these deals.
Awesome. Thanks, Jonathan.
Thank you.
Mhm.